Howdy, Jacob here. Today we're going to do a more in-depth analysis on Shoals Technologies, company 111 of our high ROIC screener. It got within 10% of our initial buy price, so I wanted to do a deeper dive. Just to remind ourselves a little bit about the company, it's in the electrical equipment industry, 1.7 billion market cap, just a little bit higher enterprise value, huge growth on revenue, and then also slight increases on operating margin and gross margin. The rest of the numbers will be in the notes that I reviewed. So the first note I have is that revenue growth, gross margin, and backlog appear to be the most important metrics pointed out by the president and the CEO. They added a new CEO in 23 Q2, so that's why I said president and CEO, since the um, the first the first year's worth of quarterly reports that I reviewed had the interim CEO point out comments, but it seems like CEO still, the current CEO, the last two reports still points out the same items. And so these are definitely the most important metrics to them, which is fine. I just point this out to say I prefer companies focus on free cash flow, but for a young business, I don't think it's very surprising that they're focusing on gross margin, which is just your revenue minus cost of goods sold, and then revenue growth. Really trying to incur some growth here. Their shares have grown quite a bit over the last year, 44% in fact, but this was converting Class B shares to Class A. The company removed all of their Up-C structure, so basically they were an LLC prior to IPO in 2022, but they still had a fairly complicated structure, and so they basically are now in December of 2023 are now 100% common A common share A company, and so less confusion going on with having to give certain equity to non-controlling interests. It now is 100% to shareholders, and so but that is the reason if you see that their share count went up, it is due to that. Now I likely expect it to go up quite a bit less than that due to the fact that their stock-based compensation is not that extreme, and then they haven't been repurchasing shares, but they haven't been issuing very many either for to gain extra money and such. So I expect that to decline quite a bit. Their backlog is important, as stated above, because it takes time to customize particular electrical balance of systems to each client, which I'll say EBOS or something. That's their electrical balance of system. It typically takes about 12 months to customize, and their backlog increased 47% from 23 Q4 to 22 Q4, from 22 Q4 to 23 Q4. Backlog is at 631 million, but I do want to say that the backlog includes both contracts as well as likely to get. And so only 206 million is actually contractual. The other 425 and a half is, is still in the works, but they're likely to sign. That's how they put it as a backlog. But that's some pretty big increases there. 11 of the top 15 engineering, procurement, and construction firms, which they consider EPCs, which is their main customer base to use their EBOS product, use their projects, use them in their projects. So that just means that their possible range of customers, the largest ones are a lot of them are using them, which is a big positive. I think they have a good amount of market share there. Roughly 81.5% of revenue came from sale of system solutions, with the rest coming from sale of components. And I'm assuming that the sale of system solutions is the higher margin anyway, so that's a big positive there. They have only three manufacturing facilities: one in Tennessee, one in Bama, and then one in California. They have one customer who makes up 36% of sales, with their top five making up a total of 57% of sales. So these two aren't anything by themselves, but just something to keep in mind that obviously a natural disaster can occur anywhere. You can't expect that, but that does have to go into your discount factor and discount rate to possibly, if their Tennessee manufacturing makes up a plethora of their revenue and products, and that, an event were to occur where that would be taken out. Obviously, we're not looking at a high percentage of that occurring, but if it were to occur, that's a huge hit to revenue and possible delay and loss of customers down the road and everything. So that does increase risk. And then having one customer make up 36% of sales is just their current sales. There is 46% increase on the backlog. There's different customers in there as well, but 36% is quite a lot. And so the loss of that customer, if they were to move to somebody else or even their competitor, could cause some big concern there. But again, nothing in of itself, just something to think about when you are trying to balance out your own risk tolerance. They're the largest player in the EBOS realm, and there's a small number of competitors due to barriers to entry. They have a revenue of just under 490 million. TerraSmart is another competitor at 108 million. Bentech roughly 40 million. Then some other competitors very small, under 5 million. So they definitely got a big part of this process. And really, I mean, it makes sense. Like, you have your solar panels and then you have the box. There needs to be a way to convert that energy or transport it, not convert it, but transport it more so. And so the current systems that's in place, the electrical balance of system, their EBOS, is a more consistent way to where you don't need an electrician every single time you need to fix something. Anyone can do it with instructions, and so it makes the cost relative, much lower than just regular wire put ups, and then also it's cheaper. So big positives there. That's why I think that the growth is still quite a bit to come for the EBOS realm. And then I have a quote from the 10K. While highly specialized and flexible, our manufacturing equipment is not costly, and we believe we do not require significant capex to maintain or increase our manufacturing capacity. It's good to have to thinking about capital expenditures, which is the minimization from cash from operations to get to free cash flow. So they're just saying that it's not a capital intensive business, which is awesome, and they have much more cash from operations than capital expenditures to keep on with their free cash flow. Their intellectual property consists of 26 U.S. trademarks, 5 pending, 19 U.S. patents, 16 non-U.S. patents, and 33 patent pending, scheduled to expire between 2031 and 2037. So they still have quite a bit of time for that intellectual property to really grow, and for competitors to really not utilize some of those products that make them unique. Notified by some customers that a subset of wires was on acceptable levels of shrink back, with the company believes to be due to Persian. It's just a company that produces the wire. And so they're currently in litigation with them. They have already recorded a $50 to $60 million loss due to this, but they are saying that the possibility was between that, like, 50 and 60 million and 180 million. And so there is still a good amount of loss that could incur beyond what they're saying. And so this is another thing, not by its own. They just, they made an assumption of 50 to 60 million, but it could actually be quite a bit higher. And so that just needs to be taken into account, and then keep an eye on it when you buy the company and you're reviewing it. The quarterly reports, just make sure to look at what they're saying about that. Their property and business insurance is in place if damage or disruption occurred to any of the 3 facilities. So that doesn't necessarily guarantee revenue stream, because obviously you lose customers, that hurts things a lot more down the road, but it is a safety measure. And then I just note that 30% solar tax credit is still in place from the government until 2032. We don't know if that's going to stick, but just noting that they don't have any intention to pay dividends. They expect to reinvest everything in future earnings, and recent future earnings at least, into operating the business and increasing the business. Revenue is up huge, 50%. Gross profit up less. Net income down, actually. But there were some one-time charges, so if you take that out, net income is actually up. And then there was a $62 million wire shrink back, stated before, that is causing a pretty big decrease to their gross profit, which actually would have increased. But it's still a cost, so you can't just take the cost out. Just saying, just noting that they did reduce their debt by 50 million. They have 2 million due in 2024, 2 million in 2025, and then 180 million due in 2026. If I incorporate my new assumptions, which basically just minimize the margins just a little bit, they increase the share change, and then a just slightly bigger discount we get to a price that needs to fall 28%. So still not too far off, honestly. And I think it's still a great company that has a lot of growth out of them. So hopefully you enjoy the video of grocery. Thank